Okay, sounds good.
Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got Sylvia Jablonski with me today from Defiance ETFs. Hi Sylvia, how are you doing today?
Hi, I'm great. Thanks for having me. How are you doing?
I'm doing great. I'm doing great. This was very, very short notice, so I just want to tell you thank you. I appreciate it, and we're going to talk about the reverse split that you announced for a couple of your Defiance ETFs, the really, really high yield ones. So I'll just share my
Okay.
screen real quick. I mean, here this is was the announcement, right? So you're doing
Yep.
it on the QQQY, JEPY, IWMY. These are the Nasdaq, S&P, Russell 2000 high yield, daily option income ETFs, which we've discussed before. I talked about it with Jay. So we're really going to focus not on the funds themselves, but really on the reverse split. And I'm talking to my audience here. I'll put the link to the press release in the video description below. So the first question, Sylvia, the obvious one: why did you guys decide to do this?
Yeah, so it's the same reason that many ETF issuers actually do reverse stock splits when you have a particular ETF product and you have a NAV that's falling, you want to essentially get it back into a healthy, stable trading range. So it's a very common, typical corporate action that you see amongst ETF issuers. Sometimes you do a forward split, sometimes you do a reverse split, and ultimately it tends to lead to a more stable, pricing ecosystem for the ETF itself.
Yeah, that makes total sense. So you have the FAQs right there on your
Yeah.
website, right? Will this change your investment value? No. Will this change the yield, or does this impact the performance of the investment? No. So there's a
No.
lot of investors who think a reverse split is typically a negative thing. It's something a bad sign with the fund. Can you
Yeah.
explain why that's this is what I think and what I told them. That's really for a single stock, a single company, nothing to
Yeah.
do here with an ETF. Can you explain why that's really not the case here?
Yeah, I mean, nothing really changes other than, you're reducing the outstanding number of shares and you're increasing the NAV. It doesn't mean anything bad. It doesn't mean anything good. It's simply a corporate action to essentially restate the NAV at a different trading price. Again, stock splits, reverse stock splits are so common. And I think it's ultimately there's no net change for the investor in terms of the value of their portfolio. It's the performance of the fund is actually going to be based on what actually happens on a day-to-day basis, the amount of income we generate, the performance of the underlying index that we track, and the reverse split will not have had an impact on the performance, if that makes any sense.
Yeah, it makes perfect sense to me. Just try to explain it to people who don't understand that is the difficult part. So in terms of one for
Yeah.
three, I look at it like you're giving up three loonies for a $3 bill if a $3 bill
Yeah,
existed, right?
right.
It's the same thing, and that's why the
Same
value of
thing.
your investment it doesn't
It's a
change,
great
right?
way to explain it. Yeah, I think a very good way to look at it.
Yeah, yeah, and we've seen some reverse splits with these really high yield funds. We saw one on Tesla from Yield Max, who's
Yes.
also under the title umbrella. I expect. So this is my next question for you. I expect for these three especially, and even on the Yield Max side, there's going to be a lot more reverse splits that are going to happen because if you understand the fund and you're getting 30, 40, 50% plus yields, the stock price has to go down over time.
Yes.
There's no way about it, right? I mean, it can't stay the same and get 50% yield. So I understand this 100%. So would you say that we could expect more in the future and this is completely 100% normal?
Well, it's 100% normal. I can't, kind of guarantee or confirm whether or not we'll see them in the future, but I think that your thesis as to if we are able to continue generating these high levels of dividends and we're paying them out and you're getting some NAV decay when the dividends are paid, then there is a likelihood that funds like ours could undergo future reverse splits, right? These aren't, these are hyperbolic income funds, right? So actually you have kind of like lower volatility, less risk than the underlying index because of that daily income. So that's a plus. And then you have this massive income payment, that's a plus. But it does get paid out of the NAV. And so a lot of people kind of view that as a negative thing.
Yeah.
What we always say to that is it's total return. So make sure when you're looking at your performance, the performance of these funds is very good. I'm not kind of promising it always will be or that it always was or whatever it might be. But if you look at these funds, you know, kind of year to date as compared to their peers, they've done quite well. You have to take the price return, add back in the dividend, and that's what you have. But yes, I think whether it's a levered and inverse ETF, whether it's an ETF, you know, single stock ETF that just pays a huge dividend, and you know doesn't necessarily capture all the upside, or whether it's any of these call strategies, put strategies, OGTE, you know, options, income types of strategies, I think it's possible that you see reverse splits in these, whether target income or these, you know, it all depends on how the NAV goes and how the distributions look over time.
Yeah, you mentioned, you know, the number one complaint, criticism, concern I get with all these high yield funds is a term called NAV erosion. You mentioned NAV decay. I made several videos about this. I actually say that NAV erosion is a myth, because how could it be NAV erosion when the NAV, when it's getting paid out and it's coming to you as cash in
Right,
your
right,
pocket?
right.
Erosion and
Yeah.
NAV decay means it's disappearing. This is not, anyway, we could do a whole other hour on
No,
talking
and
about that.
it's so awesome, and we're so appreciative of you getting this information out there, because we do have, you know, there is a large group of
Misunderstood.
individuals. Yeah, it's misunderstood that they absolutely love the product, but then they kind of look at it and think like, oh my gosh, I'm down 10%, and we're sort of like, how does, you know, I see it up 11%. How could there be this 20% span? And it's oftentimes that like they don't go back and add the dividend back into the price. And the cash is part of the investment, right? It's the whole
Yeah,
reason we're
they're
doing it. We're paying these extreme dividends. That's kind of the goal and an interesting thing about this product. And then you either take that cash, you reinvest it in you know, our product, you take it and you put it in a CD, whatever you want to do with it, right? It's your cash, but you do have to kind of factor that into your total return. And that's how, you know, that's kind of how you get to the end number there.
well, of course, you know, they spent all the money,
Yeah.
they take the big dividends and they're happy and they invest in something else, or they spend it and then they're like, well, I'm down 10%. No, no, you're not. Your
Right.
capital is down 10. You got to factor in the capital plus all the dividends you got. So this actually brings me to my next question. So with yields of north of, you know, 30, 40,
Yeah.
50%, you could pretty much guarantee that the stock price will go down over time. So I typically recommend investors to you know, reinvest a portion of the income, all of the income, especially if you're living off of this, right? If you're a retiree, if you're someone who's living off of this income, you can't just expect to pull out all the income, spend it every month,
Right.
and your cap, you got to reinvest some of it when you're getting yields of north of 30, 40, 50%. So would you say that maybe these funds, and I'm talking specifically on the three,
Yeah.
QQQY, JEPY, IWMY, are maybe not really ideal to live off of? And what I mean by live off of is pulling out all the income every month of spending it. You got to reinvest a portion of it. But maybe the other set of three, which there's SPY-T
Yeah.
and QQQT out now. We know the Russell one is on its way. I saw your conversation with Retire on dividends now, by the way. So you really have those two sets of products, right? You got the QQQY, JPY, the Russell one, super high yield daily. Then you got the SPY-T, QQQT, the Russell one that's not out yet. I'm assuming that one also is going to target 20% yield annually as well. So these
Yes.
have, you know, a target of 20%. They have lower yield, which means a more sustainable NAV. So would you say that those are more ideal if you're living off the income or pulling it all out?
Yeah, absolutely. And that's always how I answer that question. You know, if you're looking for income to live off of and you want to take the whole thing and you know, you don't want to essentially portfolio manage. And we actually learned this from you guys and from your listeners. There's this group of people that says, I love this product, but I don't want to do that. I don't want to deal with reinvesting. I don't want to portfolio manage. I just want to take my income and run. And then
A
we
lot of
thought,
people don't, right? They got a life to
right,
live, right? They don't want to stay in front of the
right.
computer.
Yeah, exactly. And so, so kind of like 2 points on that. So the reason why we came up with 20%, because 20% was the best back tested number where you kind of kept that stable NAV. Um,
Interesting.
but you got a high enough dividend. As soon as you go into the 30s, like that NAV decay starts to pick up. And so 20% was sort of the sweet spot. We thought it would be something that, the investor would be happy with, and they can kind of take their income. Because you're capturing more upside on the NAV, right? So that in theory, we could have a more stable NAV when you unlock the covered call with the selling the credit spread.
Yeah.
But I actually saw one of your videos, and it's not one that we were talking on, but it was a while back when we launched the fund. It was maybe a week or two after we launched the funds. And I thought what you said was really interesting. You said in one of your videos, and I can't remember your exact numbers, but you said something like, I actually only take like 25% of this and I reinvest 75%. And then,
Yeah.
yeah, you said that back then. And for a while I was like, this, I was like kind of quoting you. I was like, well, this is how someone does it. And I actually think that this is really smart, right? Because you're buying share, you're kind of like improving your cost basis, you're buying shares, right? Dripping, having the money work for you, but then you get to take your 25% and do something else with it. And so you're happy. And I always thought that was a real kind of like sweet spot proportion.
Yeah.
But then these funds also, the target income funds kind of also resolve that. And so you have the two options to do it.
Yeah, so that video was about how these funds are not ideal to live off of,
Yeah.
pull out everything
Yeah.
out, but it doesn't mean you can't do it. But if you want to have a stable capital, you're going to have to reinvest a portion of it. My
Yes.
thesis is that between 10 and 15% is maybe the sweet spot. So your target ones have 20. So it's a little bit higher than what I feel is the
Yeah.
sweet spot. But the thing is that everyone has a different sweet spot. Some are more
True. True.
conservative.
Yeah.
They like 8. There's a popular Australian income YouTuber that his magic number is 8. Armchair
Yeah.
income or armchair finance. I think it's between 10 and 15. For me personally, I like near the 12, 12 and a half, 13. But it's different for everyone. But
Yeah. And
you can't
Retire on
expect.
Dips, I think, was telling me his sweet spot was more like 40,
Yeah,
30
well,
or 40,
that's a
right?
very
So
generous sweet spot, sweet spot, for sure, where you could
yeah.
pull everything out because you got to look. I mean, you're still invested in the indexes, Nasdaq,
Right, right. And that's what I was
Russell.
going to say. It's not necessarily wrong. We don't know what the outcome will be, right? And I think that the gut reaction of a lot of investors is like the higher the dividend, the better. And of course that's true, but you do have to kind of calculate like how much of the upside of the index are we going to get through,
Exactly.
uncovering
Doesn't mean the
costs,
return is a yield does not equal return. That's another thing I
return.
keep telling
Yes,
people. Yeah.
yes, yes,
Yeah, for
yes.
sure.
Yes. And
Very.
it's actually just been a great learning experience too, to just even be careful with all of our words on everything, right? To educate and ensure that we're telling people to kind of reinvest or just so that they know what the expectation is if
Yeah,
they
me too,
do
actually.
invest
Yeah.
versus they don't, right? And then, what you said too, just delineating also the difference between price return and total return, delineating the difference between income and total return, right? So we are returning what we always said we would from the beginning. We said, QQQY, it's going to annualize around 60%, and it's annualizing around 60% of income, right? Total return is not 60%, right? Total return
Different.
is, yeah, it's different.
It's
It's
based on
could
what the
be
Nasdaq does or the S&P
exactly,
plus.
yeah,
Yeah.
yeah,
Yeah, it's important to understand that, and that's why I think you guys are very very smart to come out with two sets of products, the same three indexes. The Russell one in the second set is not out yet, but it probably will be soon. But I tell people, look, the SPY-T, QQQT, these are better strategies if you feel like you're more bullish on the index because it captures more upside. So myself personally, I recently swapped my QQQY into QQQT because I'm more bullish than
on
bearish
NASDAQ.
on the Nasdaq. I think, I'm holding this for 10 years. And by the way, I had QQQY on the whole thing on drip. I was just compounding. I just swapped it into QQQT, which it's the same investment. It's just the strategy or the option strategy is different. It's a daily spread instead of a daily, put
Yeah,
in the money put, but you're capturing more of that upside. And what I tell people is put it in your watch list, put QQQ or QQQM, and then put QQQY, and then put QQQT, and put the other competitors if you want. And every day
yeah,
you'll see the performance.
exactly.
And
Yeah,
it's very simple. If the market is flat or has done or is going down, QQQY does really well because it
yeah,
makes a lot of premium.
yeah,
But when the opposite is true, when the not like today, July 22nd, the
Yeah,
Nasdaq's on fire.
QQQT will do better today.
Exactly,
Yeah,
QQQT will
yeah,
because it captures more upside, but you have a little bit less cushion or downside protection. So it's all about figuring that out and figuring out which best strategy is best for you. Then you have QYLD, which is on the other side of the spectrum, which is I give up all the upside. So that is the
right,
most defensive product and will probably do the best when the Nasdaq is having a really, really, really crappy bad
right.
time. So this brings me to my next question. Thing,
Yeah,
and I'm going to focus on the QQQY, back to the high yield ones. QYLD reinvests half of the income back into the fund
mhm,
automatically for investors. That's why the stock price is, is relatively flat, relatively stable. They actually kind of do it for you. It's a policy in the fund. You guys don't do that. You give out all the income, make the
yes,
investor decide what to do with it, which is honestly my preference. I
yeah.
give me the freedom to do because of the NAV or the stock price continuously going down with these really really high yield ones. Have you guys considered? I think I asked you this before.
Yeah.
Having changing the distribution policy, maybe reinvesting some of it, or like 50% of it, 60% of it, or you're just going to leave it like this for now.
We're going to leave it like this. It's a, it's a rules based. This is essentially how we created the product to build it. And we actually think if you compare the performance, we're happy with where we're at as compared to our competitors on this. And yeah, it's really up to the client to decide what they want to do. It's easy to just kind of select drip, right? If you want to do it. But I think also coming out with the other group of products, we sort of resolved it in that way by
Yeah.
creating a second option. So yeah, we're not looking to change them now.
Okay. Sounds good.
And we're
Well,
not
that.
really being asked to. It's really interesting. It seems like it's kind of like a polarized type of thing, right? You have some clients that are just 100% all in QQQY, IWMY, JEPY with a Y. They're so excited about these products. They love the dividend. They totally know what they're doing, reinvesting using some of the cash, and then there's the other client that just really wants to take that 20% target income. They want more, as you said, exposure to the underlying index, and they're just 100% in on target income funds. So it's good. We have Goldilocks and the
No,
the
no
two
pun
products.
intended, but you got options. You got plenty of
We have
options here on
options. Yes,
what's
yes.
best for your investing situation as of now. If you're, you know what I mean, there's a million way to play these, or we won't get into
Yeah.
them. I made a video on how you could play these. Some people reinvest half. They drip the whole thing because that's just the most hands off. They reinvest in something else. They'll literally take the income from
Yeah.
QQQY and they'll put it in
And
QQQ
put
or
it in the video.
QQQM.
Yeah,
Yeah,
right. Or
exactly.
something completely different. Completely different. Yeah, yeah.
I love that, honestly. I love the giving the power to the actual individual investor. I don't QYLD does their thing. They reinvest half of it. That's fine. But I could pretty much guarantee if QYLD gave out all the income, they would have done a reverse split also by now. I mean
Oh, yeah. I
that
mean,
for sure. That's my assumption.
right.
I think I'm like 99.9% right on that. So
Yes.
um, I won't hold you much longer. I'm sorry about the noise here. By the way, there's construction
Oh,
in the
no worries.
building.
No worries.
I have one final question, which you probably can't answer, but I know you talked about it with my buddy, Retire, who I met at the New York Stock Exchange and everything. So he's a cool dude.
Yeah.
So just to reiterate, again,
Yes.
in terms of the reverse split, nothing to do with negative performance of the fund or
No.
anything like that, right? This is a normal
No.
thing, propping up the share price. Will you'll it's like trading in three loonies for a $3 bill. Just one quick question: is there a limit on how many times you could do a reverse split? Because ETFs are kind of different than a regular
Yeah.
stock, like company. The shares grow based on demand. So let's say you have to do it again in 3 years or 5 years, and then you have to do another one in another 3 years or five
Yeah.
years. Would that be a problem that you're doing it multiple times, or it's not a thing?
I don't, I don't think that there's a limit. I think that, if the overall intention is to benefit the end shareholder and make sure, you're kind of maintaining the integrity of the fund and not letting it, you wouldn't want a fund to go to zero. Not to say that ours would, but take a levered inverse ETF, right? If you had like 30% move at a very, low price, you have the risk of an ETF getting wiped out. And so no ETF company wants to do that. You want to preserve the value of the fund for the shareholder. And, that can be the purpose of the reverse split on that effect. With income funds, it's not quite that. It's not a leveraged fund. It's actually like lower beta than market. It's just more to maintain the integrity of the fund. To my knowledge, there's no, kind of limit. Our goal is obviously not to just do a bunch of reverse splits. There has to be a good reason for it. And again, we believe that, in our due diligence, this is a good reason to just maintain the integrity of the fund.
Sounds good. So you kind of mentioned leverage there, and I know you discussed this with my good buddy there in the U.S. But now that you have or maybe once the Russell one comes out, you'll have the two sets of products, right, for the three indexes. You'll have a total of 6 products. Really high yield, but both sets do daily strategies, but one has a 20% yield target, the other ones are much higher. So now, or when everything is going to come out, what's the next step in terms of funds? What are you most getting requested for? Is it an all-in-one to maybe combine the 3 indexes, equal weight, one set and another set? Maybe a combined leverage version. Are you guys thinking about what's next? I know you can't talk about future products, but
Yeah.
for example,
We're thinking about all of these things. I mean,
uh-huh.
we're thinking about, different income types of strategies that haven't been done yet. A lot of people ask us about fund of funds. A lot of people ask us about leverage versions of funds and things like this. And so we're always on the whiteboard. We're always coming up with new ideas. The
Nice.
next launches that we have coming up are very likely to be, 2 times leverage, single name stock ETFs that rebalance on a daily basis. So leverage single stock funds, hoping to get a couple of those out soon. But yeah, we're
Growth
always
or income versions of those, like covered call versions or just growth?
so on the 2X leverage funds, it'll be a single name stock. So it'll be, you can kind of see the list that we have there, but on that list, you have names like, Lilly, Broadcom, MicroStrategy, Super Microcomputer. We have a whole list of them. And so we're likely to come out with the ones that we think might be interesting, but that's not income. That's more,
Yeah. They're pretty popular. They're getting more popular. That
yeah,
style
for
is
sure.
getting, yeah, for sure.
For sure. It's a totally different trader though,
Yeah.
than, who you're talking to. Like you don't kind of like set it and forget it with those, but
No.
actively manage and understand
Yeah.
the risks and that kind of thing. But yeah, we're always looking at different ideas in the income space. We have USOY, actually your buddy called it USO, so I remember she's got me calling it USOY. So the oil fund that pays income is out there as well. That's actually just, that paid a hefty dividend. And so that got people really interested in that particular ETF too. So yeah, you'll definitely see more from us.
Sounds good. Looking forward to it. So thanks again for your time. This was
Yeah, of course.
completely
Thanks for having
unplanned.
me.
I really appreciate it and hope to talk to you again soon.
Anytime. Thanks for having me.
My pleasure. Take care.
Thank you.